Welcome to our quarterly investment market update for June 2023. Steve, we've had end of financial year just come and go. Markets are up. There's a lot in the news about AI and how this is going to affect the world. Interest rates are still on the increase, although the Reserve Bank put them on pause yesterday. Can you give us a quick update as to what's happened over the last 12 months?
Yeah, sure, Sam. Let's start with Australia. And it's been a really good first half of the year, Sam. You can see the market's up by 4.5%. Even better, the market's up by 14.8% for the 12-month period. The other thing you see in that chart, Sam, is that the volatility has been coming down. So the volatility is as low as it's been for many years. So it's a good combination. Market's going up, low volatility.
Sounds like high returns, nice and safe.
Absolutely. Well, that's what the market was thinking, yeah.
What about the international shares markets there, Steve?
Well, Sam, if we thought Australia was doing well, have a look at the international market. So this is the developed markets on the left-hand side, which is ex-Australia. And you can see that for the first half of this year, they're up 17.5%. Now, the biggest part of the developed markets is the US. They're about 65%. And look at that, they're up 19%. But it is broad-based. Europe, and who would have thunk with what's going on in Europe, they're up. And Japan, where that economy seems to always sort of be in the doldrums a little bit, that's also had strong returns. So it's across the board. When we get to the emerging markets, Sam, you'll see that's not going so well. That's facing a few headwinds. The first one is a strong US dollar, always seems to dampen emerging market returns. And the other thing is China really is not coming out of its post-COVID lockdowns the way people thought it would. So the Chinese market was a big part of the emerging markets.
If we just focus just for a moment on the developed markets, which are obviously influenced largely by what's going on in the US, and over the last 12 months, we've seen the US share market go up by around about 22.6%, which is just extraordinary and clearly not sustainable over the long term. Can we drill down a little bit into that, and so that everyone at home can have a bit clearer of an understanding as to what's driving that at the moment?
Yeah, Sam, when we look at the next chart, I think most people have heard of the S&P 500 index. So it's the big top 500 companies in the US, and that's the one that's always quoted. But when you break that down, it's made up of stocks or companies from two different exchanges. One of the stocks on the New York Stock Exchange, that's a slightly larger bit, and the other one is the NASDAQ, which tends to be where the high-tech stocks live. Look at the chart there. The New York Stock Exchange actually is, well, a bit better than flat, but it's not doing anything extraordinary. It's all happening in these high-tech stocks.
Yeah, look, it's personally, I'm excited as to what AI might bring to us. And a little bit scared as well because you never quite know. But I sometimes just get a feeling of, is this going to be another .com sort of situation again? So we need to exercise extreme caution when we're looking at these things and constructing investment portfolios for clients.
I think that's right, Sam. And of course, one thing with our portfolios, Sam, we have exposure to this because in our international portfolios, they're linked to market cap weights, which means we get these NASDAQ stocks as well as the New York Stock Exchange stocks, as well as Europe and Japan. So we are getting the benefits of this without having to bet on the fad.
Yeah, fantastic. What about the bond market, Steve?
Yeah, so the bond market obviously is sensitive to interest rate movements. It had actually a good first quarter, and that's because yields went down when the US banks collapsed. But what we've seen in the last couple of months is central banks keep raising rates. And even if they don't raise rates, even if they put them on pause, the commentary afterwards is there's another rate rise to come. So that lifts up yields and that dampens the returns of the bonds. And you can see there's very small negative return in bonds for the quarter.
Keeping in mind for our clients of Insight Private Wealth, you understand the importance of having that long-term growth focus and making sure that the portfolios are well diversified, trying to manage the risk. And as you said earlier on, not speculating on what's going to go up or what's going to go down, but have more evidence-based approach to our investment philosophy. For people out there who aren't clients of the firm, please keep in mind that Insight Private Wealth is not owned or controlled by banks or super funds or any of the other large institutions, and we don't accept any sorts of investment commissions. So this ensures that the professional advice and independent research, information, etc., and so forth we provide to clients, it's always in your best interest. So please contact us today if you need any help, and we can certainly explain to you how we can help you with your financial lifestyle planning.